So, Mike, I promised Romaine that I do the nerdy stuff first, so fair enough. Let's start with the Permian, because the growth rate in the Permian was truly spectacular. Production overall was up 14%. 14% growth in the Permian. That's incredible. And if you take a look at what your growth forecast is going to be over the next year, you're still looking at that 1 million barrels of oil a day for 2025. What is really driving that?
Well, Alex, it's great execution. And it really starts outside the Permian. It was a year of records for us. We had record global oil and gas production of 3.1 million barrels a day, record U.S. production. And in the fourth quarter, we had record Permian production of over 870,000 barrels per day. So really strong performance in our business across the board allowed us to return a record $26 billion to shareholders, almost 10% of our market cap. And as you mentioned, we raised our dividend 8% earlier this year. So strong performance, around the world. Permian certainly showing very strong growth and momentum as we move towards 1 million barrels a day in 2025.
So, Mike, you mentioned on the call that you weren't going to be increasing CapEx. So I'm just wondering what your confidence level is in maintaining and improving those productivity and efficiency gains.
Well, capital discipline always matters in our business. And for years now, we have been very committed to a tight capital budget and focusing on execution. What we've done now in the Permian is we've grown to a point where we'll hold our CapEx as guided, about $5 billion this year, and see continued growth this year and next year. And as we get to next year at 1 million barrels a day, we'll start to talk about holding a plateau, which allows us to actually invest even less capital in order to do that. So we're very committed to capital discipline through the cycle. It matters in this industry. It's an industry that at times hasn't necessarily exhibited that. And I think it's important that our company and other companies remember the lessons of commodity markets.
What does that mean, Mike, going forward here once the acquisition of Hess closes later this year here? What type of changes still need to be made?
When we closed the deal with Hess, which is expected mid-year, we've got a fairly involved FTC information request that we're in the midst of right now. We'll have a company that has even stronger production growth further into the future. It will allow us to underpin not only the dividend, but also a very strong balance sheet and continued share repurchases, not only through the balance of this decade, but well into the next. So it takes what's a strong portfolio for us today, and it makes it even stronger for longer.
And then, of course, looking at the strength in the stock, looking at the strength of the balance sheet, Mike, I'm sure you've heard the questions here. Do you plan any other major acquisitions this year?
We just completed one acquisition last year. We're in the midst of another one. And we're always alert to opportunities, but integrating a company in our industry matters. We operate in challenging environments. The work we do needs to be done with precision to keep people safe, to protect the environment. And integrating two companies together and all the things that go with that are something we take very, very seriously. And so we've got our hands full right now. We'll work hard to close the Hess deal and do a good job integrating a great company with ours. And as we go forward, if opportunities present themselves, we'll certainly evaluate them. But we're not feeling a need to do anything.
That was CEO speak for, not right now. I got a lot going on. Fair enough. Hey, Mike, we talked about the buyback and stuff and sort of bought back about 5% of your stock last year. Do you guys have a target for what that's going to be this year?
We're right now under some SEC constraints because of the transactions, but the last 2 quarters we've bought back about $3.5 billion each quarter. Once we're out from under those constraints and we have the Hess shareholder vote, we've indicated that we would step up to a $20 billion run rate in a commodity environment like the one that we see today. Last year, we repurchased just short of $15 billion. And so that would be a significant step up. It would be a sign of confidence in the future, just as the 8% increase in the dividend this week is a sign of confidence in the future. So that's the guidance we've currently got out there in the marketplace.
Mike, I'm interested, if we just take a step back for a second, the last 12 hours was about big oil delivering, and it was also about big tech delivering, and both now have dividends and both now have buybacks. How does oil, big oil, stay relevant in a market that is just obsessed with AI and big tech?
Well, it's a very interesting market, and I know you were talking about this earlier. There are a handful of technology companies that really have been driving this market, and the valuations obviously have gotten to levels that we've never seen before. We are an essential industry to the global economy, or an industry that's been around for a long time and will be around for a long time in the future. We have a track record of generating cash and returning that to shareholders. So our dividend yield is above 4%. We've increased our dividend for 37 consecutive years. Our dividend yield is more than 2.5 times the yield of the S&P, and our free cash flow yield is almost 3 times the S&P at over 8%. And we've got a track record of returning that to shareholders, and yet energy trades at about half the multiples of the market broadly, and even less than some of the companies that you're referring to. So there's a real value opportunity here for long, patient shareholders to secure income, to secure the future appreciation, and it's underpinned by the strong cash flow, the strong balance sheet, and the track record that a company like ours offers.
What is, I guess, the corporate future of Chevron here? I mean, looking through today's numbers, Mike, of course, we had that big write-down, the $3.7 billion, stemming from a write-down of those California assets. And of course, there's a much bigger story behind that with regards to the legislative changes that have already come down the pike and some additional regulatory changes that might also be coming. Is Chevron still wedded to California as its home base?
Well, California has, for the last couple of decades, pursued policies that are intended, and this has been a part of the plan, to reduce demand for our products, which hasn't really happened. Demand remains very strong, but also to reduce investment in our industry. And these policies have made investment in California less attractive than investment in other places in the U.S. and other places around the world. And what it's likely to do is reduce production and reduce supply. And if we don't see a corresponding reduction in demand, that creates some risks for the marketplace. But policy choices do have investment consequences. They do influence investment decisions. And what we see playing out in California is exactly what the state has been seeking.
Mike, do you want to move to Texas?
We've got a lot of operations in Texas. We've got a lot of people in the great state of Texas, and it's where a lot of the growth we've been talking about in the Permian Basin has been occurring. So we've got a large presence there, and it's a growing presence.
Fair answer. Mike, to that point, I just wanted to get your sense. There's so much to get through, too, but geopolitical risk. Where you sit, what's the biggest one? Is it California? Is it U.S. policy, a.k.a. a moratorium on LNG exports? Is it Venezuela? Is it Guyana and Venezuela and Guyana and that dynamic there? What keeps you up at night among all of those?
Well, our business brings with it geopolitical interactions and geopolitical risk. You've run through a whole series of them that are part of our world. Some are present in the short term. So the Middle East presents risks each and every day to security of passage of vessels, the risk that we could see some sort of interruptions to flow. You get out into a medium-term time frame, and some of the policies in the U.S. where we've seen mixed signals from the administration. In some instances, encouragement to invest and grow, particularly when prices were high. But in other cases, cancellation of pipeline, cancellations of lease sales, pausing on LNG export processes, which discourage investment. And so these mixed signals in the medium term run the risk of creating some consequences. And then longer term, when policy stays consistent, as it has in California, and it starts to influence supply, when demand is unchanged, that creates a different set of issues. And so we deal with geopolitical risk in every time frame, and frankly, all around the world every day. It's why you need a large portfolio, a strong balance sheet, a diverse set of opportunities, so that you can manage that risk with all the tools that we have.
Mike, before I let you go, talking about risk, you got Brent at 77, WTI at 72. Does that surprise you, considering all the risks you were just talking about?
It's a market that is relatively balanced right now. We've got OPEC Plus making some cuts. Demand has been strong. We saw demand go up a couple million barrels a day last year. Global economy, certainly here in the U.S., with the jobs report and other indicators we're seeing, and demand in our industry is strong. China is growing again, and not maybe as strong as it was a few years ago, but China's growing. Europe, not so much, but global demand is going to increase again this year. Supply has been keeping up with that demand, but the risks that we see in the Middle East are very real, and they could move markets. One thing that's different is the U.S. is now the world's biggest producer. And if you go back to periods in the past where these kinds of risks really did get priced quickly into the market, it was because the U.S. was so dependent upon supplies from the Middle East, and other parts of the world were as well. Today, with the U.S. as the world's largest supplier, there is a different balance and a different set of exposures that I think the market is also, pricing in.